Hi everyone, welcome to my YouTube channel. So yesterday I received a request from one of a particular student of mine that sir please share a conceptual understanding video on de-gearing and re-gearing. This is from the FM subject de-gearing and re-gearing. Okay. Now let's understand what do I mean by this. I have my business by the name let us say BW Limited. I am into a business of let us say manufacturing the water bottles. My business is manufacturing and selling the water bottles. Now, obviously, I am an unlisted company, means the securities are not traded on the stock exchange. My securities, that is the equity shares and the debentures, are not traded on a stock exchange. Now, I want to find out the cost of equity. Cost of equity by using the CAPM formula, that is capital asset pricing model. The formula is RF plus beta Rm minus Rf. Now I am concerned with the beta over here. I want to find out the beta. I am an unlisted company. Now I get the beta for the listed company shares only. Now what is beta? It is the sensitivity of my share price. What I will do in such a case is step one, I will find out a proxy firm. Now what do I mean by proxy firm is I will look out for any such firm which is into the same line of business, that is manufacturing the water bottles, manufacturing and selling the water bottles, but it is also listed on a stock exchange, which is a listed company. Means the equity shares and the debentures or the debentures of these companies are traded on a stock exchange. I will take up the beta of this particular proxy firm. Okay, so step one, identify the proxy firm. Step two, take beta of proxy firm. Take beta of the proxy firm. Step 3 is de-gear the beta. Step 4 is re-gear the beta. Now, if I talk about beta, guys, beta is nothing but a risk. Let's understand risk. Beta is nothing but risk. Now, every corporation, every company, every entity, they have two types of risk that they have to manage. Number one is the business risk. Now, this is the risk which is due to the nature of the business, due to the industry. Now, obviously, will have every business will have its own risk depending on the industry they are in. Second, what they have is a financial risk. Now, if I say financial risk, then it means the debt equity ratio, that is the gearing. That is simply they are talking about the gearing ratio, also known as my debt equity ratio. That is a mix of debt equity. How much do they rely on debt? Higher the debt, high risky the company is. Now let's understand logic firstly. What I will do is I will take beta of the proxy firm. Now can I say because this is a proxy firm, the business risk of the proxy firm and the business risk of BW Limited both would be the same. The only thing that will be different here would be the financial risk. Why? Because every company will have their own debt equity mix. Let's say proxy firm is having, just an example, proxy firm is having a debt equity ratio of, let us say, debt equity is 40/60. That is 40% is debt and 60 is equity. But if I talk about BW Limited, let us say its debt equity ratio is 30/70, means 30 percentage of my capital is debt and 70 is equity. So what I do is I take up the beta of my proxy firm, I remove the gearing, I de-gear, means I remove this 40:60 ka ratio and I reinstate, what I say is the my gearing ratio, which is 30/70. So the idea would be, how do I go with this is, I will first have to find out the beta asset formula. Again, logic. Now, what do I mean by beta asset is the companies which are purely equity finance will have beta asset. Means there the gearing is zero. So my idea is that whatever is the gearing of the proxy firm, I first take it to zero. Zero as in I assume that the company is 100% equity finance. I find out the beta by using this formula which I am giving you right now. So I will consider the equity beta of the proxy firm. Now equity beta means the beta of the company having both debt and equity in their capital structure. I will convert it into beta asset. Now beta asset means what would the beta of the company be if it is purely equity finance company. And then once I find that beta, I will reinstate my gearing ratio. My means BW limited. So take equity beta, convert it into asset beta, and again convert it into equity beta by using or applying the gearing ratio of my company, that is BW limited. So this is known as de-gearing, and this is known as re-gearing. Re-gearing. Now for this, we have the formula as beta asset is equal to value of equity upon value of equity plus value of debt into 1 minus t. Now why 1 minus t? Because we always consider debt as post tax, because in case of debt we pay interest and we get tax deduction for this for this interest that we pay, and multiplied by equity beta. Now the logic is, out of the total funds employed, can I say asset beta? Asset beta means the beta of the company if it is purely equity finance, which is why I am taking value of equity in the numerator. We are giving more importance to equity over here. Now try to understand here, the value can be either the absolute amounts or it can be the relative amounts as well. Relative means I can take it either in proportion or I can take absolute amount in the absolute numbers. We will understand this once we take up an illustration. I hope this is clear. So my formula is beta asset is value of equity upon value of equity plus value of debt into 1 minus t multiplied by beta equity. Now let's understand this with the help of an illustration. Now CJ company is a profitable company which is financed by equity with a market value of 180 million and a debt with a market value of $45 million. Now it is considering an investment project as follows. Project B, now this is a diversification into a new business area that will cost $4 million. A company that already operates in the new business area, GZ company, has an equity beta of 1.5. Now GZ company is financed by 75% with equity with a market value of $90 million and 25% by debt with a market value of $30 million. Other information, I have risk-free rate of return 4%, equity risk premium 6%, and tax rate applicable is 30%. Calculate a project-specific cost of equity for project B. Now this is what do I mean by de-gearing and re-gearing. Okay, that is calculating project-specific cost of equity. Now let's try to understand, our company is CJ company. First, what we do is we identify the proxy firm. Now, proxy firm is GZ company. They have equity beta of how much? 1.50. What is the value of equity that they have? Value of equity, as I told, I can either go by amounts that they have given or I can go by proportion. Both of them will give me the same answer. Now let's go by value only because they have given us the value. I'll take it as 90 million. Value of debt is how much? 30 million. Correct? Now what I do is I first find out beta asset. Formula beta asset is equal to value of equity divided by value of equity plus value of debt into 1 minus t. Now, what is 1 minus t here? That is 1 minus the tax rate and multiplied by beta equity. Now, beta asset is something that we are going to find out. Value of equity given to us is 90. I divided by 90 plus 30 multiplied by 1 minus the tax rate is 30, that is 0.30. And I multiply it by beta equity, which is 1.50. So beta asset is equal to 90 divided by 90 plus 30 multiplied by 1 minus 0.30 and multiplied by 1.50. Now this is my beta asset. Now what is my step 2? I re-gear it. Now re-gear it means I convert this beta into equity beta by using the debt equity structure of CJ company. Again, I write down the same formula. So re-gearing the beta. I write down the same formula. Now beta asset, this time we have it as 1.22. Let's round it off. 1.22 is equal to value of equity of CJ company. It is 180 million. Equity with a market value of 180. So it is 180 divided by 180 plus market value of debt is 45 million. So 45 but multiplied by 1 minus 0.30. And multiplied by equity beta. Now I get 1.22 is equal to 180 divided by 180 plus 45 into 1 minus 0.30 and multiplied by equity beta. So beta equity is therefore equal to 1.22 divided by this number, which is 1.43. Now I want to find out cost of equity, and formula is risk-free rate of return RF plus beta that we just found out multiplied by RM minus RF. Now risk-free rate of return is given to me as 4. So I'll write 4 plus beta, we found it out as 1.43 multiplied by, now guys, equity risk premium. This equity risk premium is already RM minus RF. So do not make a mistake of doing 6 minus 4. No, that would be incorrect. So I'll simply multiply it by 6. So cost of equity is therefore equal to 4 plus 1.43 multiplied by 6, which is 12.58. I hope you found this interesting and easy as well. So you can expect a question on this in either section A or section B. Now this was a part of the section C question that I have taken. It was asked for somewhere around 4 to 5 marks. Okay, so comment and let me know how did you find this video. If you have any other topic in your mind which you want me to simplify, do let me know in the comment section. I will see you soon in the next video. Bye bye. Take care. If you are new here, kindly like my channel and subscribe. Kindly like this video and subscribe the channel, and do share it with your other ACCA friends too. Okay. Bye bye. Take care.